Silver isn't rising because investors are buying it. It's rising because it's disappearing. Silver is trading near $67 an ounce. On the surface, that sounds like strength, momentum, a bull market doing what bull markets do. But silver doesn't usually move like this in just months. It has surged at a pace that historically only appears when the market is under stress, not when everything is healthy. Short-term gains are extreme. 6-month and 1-year returns are explosive. Yet volatility hasn't faded. It's intensified. That's the first warning. Major institutions are already calling for silver around $70 in 2026. Citigroup, for example, treats that level as reasonable, even conservative, not a moonshot, a baseline. And that raises an uncomfortable question. If $70 is considered normal, why does the market already feel tight? Why do inventories feel strained? Why does silver behave like its light cycle when forecasts say it's early? Silver has a reputation for a reason. Traders have called it the devil's metal for decades, not because it trends slowly, but because it moves violently when pressure builds. Beneath the surface, this isn't how silver behaves when supply is abundant. This isn't how it behaves when demand is optional. And it's not how it behaves when the system is relaxed at $67. Silver isn't sending a celebration signal. It's sending a stress signal. And the real story isn't what silver costs today. It's why this price already feels unstable. Because when silver starts acting wrong, it usually means something underneath already is. If silver were rising simply because prices are higher, the market would already be calming down. Higher prices are supposed to do one thing very well: bring supply back. That's not happening. According to precious metals analyst Peter Croth, silver is facing something far more dangerous than a normal shortage: a structural supply deficit, not a temporary imbalance, not a cycle, a system that can't respond. Here's why. Roughly 3/4 of all silver isn't mined because companies want silver. It's mined as a byproduct of gold, copper, lead, K, and zinc. That means higher silver prices don't automatically create more silver. If you're a copper miner, silver is a small line item on your revenue statement. A doubling in silver prices doesn't suddenly justify building new mines, hiring new crews, or expanding production. In fact, Croth warns that higher prices can sometimes reduce silver output as miners process lower-grade material that contains less silver, not more. So the market does something unusual. Prices rise, but supply barely moves. Institutional research firm Metal Focus confirms this imbalance. In its latest outlook, it projects a 5th consecutive year of silver supply deficits, with shortages persisting well into 2026. Even their optimistic scenarios show no quick return to balance. And even if the industry wanted to respond, it couldn't, from discovery to production. A new silver deposit takes 10 to 15 years to come online. Price signals today can't fix shortages tomorrow. The reaction time is simply too slow. Meanwhile, above-ground inventories are thinning. Exchange stocks in major hubs like London, New York, and Shanghai are tightening. Physical availability is becoming harder to source. Lease rates are rising, a quiet sign that borrowing silver is getting more expensive because fewer holders are willing to part with it. This is the kind of pressure that doesn't show up in headlines immediately. It builds quietly. Neat. Silver isn't waiting for supply to return. It's adjusting to a world where it can't. And that raises the stakes, because once scarcity becomes structural, price stops being the solution. It becomes the signal. Supply pressure alone doesn't break a market. Demand does, and the most powerful source of silver. Demand today isn't coming from Wall Street. It's coming from factories, power grids, and data centers, many of them outside the United States. China sits at the center of that shift. It is the world's largest industrial consumer of silver, driven by electronics, electric vehicles, and most importantly, solar energy. China produces the majority of the world's solar panels, and newer panel technologies don't use less silver, they use more, in finer and purer forms. Despite being a major producer, China still imports large quantities of silver to meet its own needs. That alone tells you something about how tight the market already is. And this demand isn't optional, according to Frank Holmes of U.S. Global Investors. Silver's role in renewable energy is not cyclical, it's structural. Solar adoption isn't slowing. Electric vehicle infrastructure is expanding, and governments are locking in long-term energy transitions that require silver whether prices rise or not. Peter Croth goes further, warning that industrial demand, especially from solar and emerging technologies, is being systematically underestimated. Investors assume efficiency will reduce silver usage. In reality, scale overwhelms efficiency. Then there's AI data. Centers are becoming one of the fastest growing sources of electricity demand in the world. In the United States alone, power consumption tied to AI and cloud computing is projected to rise sharply over the next decade. And increasingly, those data centers are being powered by solar, again pulling silver into the infrastructure layer of the economy. This is where the market dynamic changes. Industrial silver demand doesn't retreat during market pullbacks. Factories don't hedge like traders. Power grids don't wait for better prices. Once silver becomes embedded in infrastructure, it stops behaving like a commodity and starts behaving like a strategic input. That's why policy risk matters now. China's resource management, stockpiling behavior, and potential export controls can shift physical silver flows almost overnight. And when the world's largest consumer tightens its grip, global markets feel it immediately. For U.S. investors, this creates an uncomfortable reality. Silver's price is increasingly shaped by decisions outside the U.S. financial system, decisions driven by industrial necessity, not market sentiment. And when supply is already constrained and demand becomes non-negotiable, price no longer asks for permission. By this point, the price targets almost feel secondary still. They matter because they reveal how divided the outlook really is. On the conservative end, major institutions like Citigroup see silver moving toward the $70 range into 2026. Indian brokerage Motilal Oswal echoes that view globally, while projecting domestic prices in India to climb sharply as structural deficits persist. These aren't speculative calls. They assume normal conditions. But silver rarely moves under normal conditions. At Saxo Bank, commodity strategist Ole Hansen points to something far more revealing than forecast flows. In a single year, investors have absorbed hundreds of millions of ounces through silver-backed ETFs, pushing total holdings near historic highs. That metal is no longer circulating freely. It's being locked away. And when investment demand collides with industrial demand, both pulling from the same shrinking pool, price behavior changes. That's why some analysts are willing to say the quiet part out loud. Frank Holmes believes silver reaching $100 is plausible if current pressures intensify. Market veteran Clem Chambers calls silver the fast horse of precious metals, capable of outrunning gold. Not because it's safer, but because it's more unstable. That instability is the risk. Silver doesn't climb smoothly. It surges, then snaps back. Julia Kondashko, CEO of Mind Money, warns that while physical scarcity is real, silver remains vulnerable to sharp drawdowns caused by liquidity shocks, sentiment shifts, or sudden changes in monetary policy. Tight markets don't eliminate volatility. They amplify it. And that's the paradox. Silver is being pulled in two directions at once. As a safe haven, it attracts capital during uncertainty. As an industrial necessity, it gets consumed regardless of price. And as a thin, volatile market, it reacts violently when those forces collide. So the question isn't whether silver reaches 70 or even 100. The real question is how it gets there and whether investors are prepared for the path, not just the destination, because when silver moves fastest, that's when it's most dangerous.